Today, I will be taking you through the world of swing trading. We will start out with the most simple question you can ask, which is what is swing trading? But by the end of the video, you will know how to easily identify extremely high probability and accurate swing trades, and you'll know how to implement those trades better than 95% of traders. If that sounds good, I just need you to do two things for me. One, go ahead and smash that like button. Two, go ahead and hit subscribe if you're new. If you're already a subscriber, welcome back. Let's go ahead and dive into today's video. So first off, let's go through what swing trading is. Swing trading is a style of trading that consists of holding a trade longer than day trading, but not as long as long-term investing. A typical swing trader will hold a trade for somewhere between 2 days and 2 weeks. Swing traders primarily use technical analysis, but sometimes add fundamental analysis to that to make high probability and accurate trading decisions. And this is something we'll be talking about how to do a little later on. But first, let's go through what you need to know before you start making high probability and accurate decisions as a swing trader. The first thing you need to know is that you're not going to go out here and start swing trading with your life savings right after watching this video. And you're probably thinking, well, then why am I watching it, Steven? You are watching it because, like any other career in the world, your first step is not to go start performing surgery on an individual that needs it. Your first step is not to argue a case in front of a judge. Your first step, if you work for Elon Musk at SpaceX, is not going to be to start building a rocket ship. Your first step is to learn. So this video is meant to show you everything you need to know about swing trading, but your job is to go back test what you learn and practice it until you are completely comfortable and consistent with the concepts and strategies that we're going to be discussing throughout this video. And I'll be explaining a lot more about practicing and back testing once we go over the rules of the strategy here in just a second. Personally, I am a swing trader in the Forex market. But everything discussed in this video will apply to any market in the world, including crypto, stock market, futures, whatever you trade, the concepts and strategies are going to apply. So let's go ahead and talk about some of the ways you can spot these high likelihood, high probability trades while swing trading. Here what you see is called a candlestick chart. If you're so new that you don't know what a candlestick chart is, there'll be a video that I did a while back in the top right hand corner of the screen that will tell you everything you need to know about these types of charts. We use these as an indication of price direction to make accurate swing trading decisions, but we don't just use candlestick charts. We combine this with other forms of technical analysis to help us make these high probability decisions. Things like moving averages and indicators, things like structure, support and resistance, candlestick patterns, price action patterns, the list goes on and on. But we find a combination of all of these things that we can set rules around called a strategy, and then we see if that strategy makes money by back testing and practicing with it. And at the point that we're comfortable going live, we then have a much better chance of creating a profitable swing trading career. So now that you know that, let's dive into the strategy. Today, we're going to be focusing on using a moving average, which is going to be the 50-period moving average. It's the blue line you see on the screen in front of you. Also, we are going to be using structure and a candlestick pattern in order to create this high probability setup that we're going to look for to make our accurate swing trading decisions. So let's go ahead and start diving into the rules of this strategy. We'll check out a couple of trades that I took actually using this strategy last week, and then we will go through plenty of examples to make sure you have a complete grasp of the strategy and you can take it, back test it, practice it, and decide if it's something you would like to use in your swing trading arsenal. So let's dive into that right now. So one of my favorite ways to swing trade is by trading with the trend. And what I'm trying to do while trading with the trend and swing trading is I'm trying to capture pullbacks before the next impulsive move up. This is what we call a trending market. Every trending market is going to have these pullbacks. And what I'm trying to capture with the strategy we're going to discuss today is the bottom of these pullbacks before the next big move up, and then the bottom of the pullback before the next big move up, and then the bottom of the pullback, so on and so forth. That's what I'm trying to capture. So what do I need if that's what I want to capture in terms of rules? Well, I need a rule for trend first, right? I need to make sure that I'm following the trend of the market. And what we're going to do for that is use an exponential moving average. So we're going to type in EMA here on my indicators. It will be the first one that pops up. my exponential moving average is going to be set to a 50 length or 50 period. It's going to be the same as chart. I'm going to make it a little bit larger just so it's easier to see. And now I have a defined rule for my strategy in terms of the trend of the market. I need the market to be above the 50 period moving average. And if I'm trying to capture pullbacks, then I probably need a rule for pullbacks too. If you can't see where I'm going yet and you're a complete beginner, when we're building a strategy, the easiest route we're going to have to actually successfully trading that strategy is by creating rules that we can follow every time we place a trade. That's how you stay consistent to your trading plan and to your strategy, is by having set in stone rules for every part of that strategy. So again, we have our rule for trend. I want to see the market above the 50 period moving average. We now need a rule for pullbacks because we're trying to catch the end of pullbacks. So for me, a pullback is anything more than 2 red candles after a new swing high. So let's zoom in here just in case you're brand new. I want to make sure that nobody gets left behind here. So right here we have a new swing high, right? Is there more than 2 candles? Yes. So this would be considered a pullback. Now we have a new swing high, but is this considered a pullback? No. And the reason is because there's not 2 red candles, but only 1. So therefore it's just like a little pause, kind of like this situation right here with this little red candle. That's not a pullback. So my next new swing high is right here. Is this a pullback? Yes, it is. So now I have a rule for a pullback, and in terms of catching the end of the pullback, what we're going to use is a candlestick pattern. So right now I'm going to go up to a whiteboard and just go over a really brief example of the entire strategy with you. And then we're going to check out a few examples on real charts to make sure you're comprehending every part of the strategy so you can decide whether or not it's something you want to put into your swing trading arsenal. So for this strategy, let's color the 50 period moving average blue. So right here, let me grab blue. Let's assume this is the 50 EMA we have on our chart. Okay, there's the 50 EMA. I'm going to use black for price. So this is what price is doing. Now that we're above the 50 EMA, we've made what? If this was our previous high, we've made a new swing high. Since we've made a new swing high, what's next? We want to see a pullback, at least 2 red candles. After we see a pullback, the way I'm going to capture the end of this pullback is by waiting for the market to have a bounce up, create a swing low, then retest that swing low. All while staying above, every bit of this must happen above the 50 period moving average. So if price is staying above the 50 period moving average, we get a new swing high, we push down and get a swing low, then we get a retest of that swing low, then I'm primed to catch the bottom of this pullback before the push higher. And the candlestick pattern I'm going to use in order to enter a trade in this instance is just what I call a color change. So if we have a retest of this area, then the color that retests it will likely be red. All I'm looking for after that is a green candle. So we have this retest of our previous swing low, and then we get a green candle. That is the entry. The stop loss is below the swing lows, and what we're trying to capture is that next impulsive move up. So let's do this one more time here, then we'll dive down into some charts. If you don't understand it yet, don't worry. We're going to go down to the real charts and discuss this strategy in a lot more detail in just a second. So we have our new swing high. What's next? We want to see a pullback. After we get that pullback, we want to see a bounce. That bounce is our swing low. After that bounce, we want a retest of that swing low and a green candle. That green candle, the close of that candle, is the entry. Stop loss below the swing low. Again, trying to capture that next impulsive move up as the market is trending to the upside. The opposite is true to the downside, which we are going to look at examples of on charts. So I'm not going to do that on the whiteboard. That was just a quick overview. Let's actually go down some charts now, though, and take a look at some real examples of this swing trading strategy. For our first example, we're looking at the Aussie yen, and I want you to tell me or leave a comment, what am I looking for right now? What do we have? What has price done? Well, according to our strategy, we need price to be above the 50. Is that rule met? Yes. We need a swing high, and we define that swing high as a high that then has 2 red candles. Those 2 red candles are the pullback. So now we have a new swing high and a pullback all above our 50-period moving average. What's the next thing we look for? A swing low. How do we define that? A bounce out of price. After we get that swing low, which is, by the way, right here, this is our swing low. We want the market to come down, test that area, and then give a green candle, and we want to try to capture the bottom of this pullback for the next move higher. So the way we do that, and we need rules for this as well, right? So the way I do that is by putting a box between the body of my swing low candle and the wick of my swing low candle. And this is where I need price to test. It can test this area with a wick. It can close in this area. A wick can go past this area. What I do not want to see is a candle that closes below this area. At that point, I have to start looking for new trades, either a new swing high and pullback or a new swing low that I can look for a retest of. So with this being the case, what am I waiting for right now? As price is right here. What am I waiting for? I'm waiting for a test of this zone with price. Is this a test of this zone? Remember what I said. Price can come into this zone. A candle can close in my zone. I just don't want a candle to close below it. So yes, we now have a valid test of our zone of structure. After we have that test, what's the entry itself? The entry itself is a green candle. So at this point, this is a good example of this trade on a real chart. We're looking at the market above the 50, creating a new swing high. Rules for a pullback are met. And our zone here is that first swing low between the body of the swing low candle and the low of the swing low candle is where we want the market to test. And then after that test, we are entering on a green candle, showing us buying pressure and showing us that this market could be continuing in trend and breaking into new highs. That is the rules for the strategy. We're going to take a look at about 2 other examples, and I'm going to show you a bearish version, go through some of the nuances of the strategy. For instance, one of them is that we can't see something like this. I don't want to see a new high and then a retest of this support level after we've already created a new high. All of this needs to happen below the previous high and above the 50-period moving average. Essentially, what we're trading is double bottoms while in trend above the 50-period moving average. So with that being the case, let's just continue here on the Aussie yen, see what would have happened with that trade. By the way, that trade, we would have entered at the top of this market. I use a 1 ATR stop loss below the lowest low of either the first low, the first swing low, or the second one. With that being the case, ATR at the entry candle is 20 pips. So we have 31 down to that. 20 plus 32 is 52. And I normally shoot for about a 1.4 to 1 reward to risk. That trade would have been a winner. Next up, let's take a look and see what we're looking for. What do we have? We have a new swing high, right? After we get a new swing high, we want to see a pullback, which is at least 2 candles. We get that. After we get at least 2 candles, we're waiting on the market to come back down and do what? What am I waiting on at this moment right here? I'm waiting for price to retest what? This very first swing low. So I'm going to put my what I call termination zone on the screen, which my termination zone is between the swing low of this swing low, the actual low itself, and the body of the swing low candle. At that point, what am I waiting on? The market to test this zone. What is considered a test of this zone? A wick can get into the zone. A wick can go past the zone. The body of a candle can be in the zone. The only thing that cannot happen is I cannot see a body close below this zone. So as long as that is the case, all I'm waiting for is that test, and then what? And then a green candle. So with this right here have been a valid trading opportunity according to this strategy. If we count off our rules, we are above the 50. We did make a new swing high. According to our last swing high, we had a pullback of at least 2 candles. We have our swing low, and we have a retest of that swing low followed by a bullish candle, giving us confirmation that we could see this market continue into new highs with this uptrend. Now let's see where this market went. At this point, your entry, well, you can tell that it won. And I know you're asking this, Steven, did you just point out 2 winning trades because you already knew that was going to happen? Isn't that hindsight? And the answer is absolutely. That first trade was hindsight, and this one, hindsight. But I actually placed this trade before this move ever happened, and I'll show you that if you look to the left side, one of these sides. If you look to the left-hand side of your screen, I have an example of email analysis. This is an email I sent to traders on the 18th or 17th of February, explaining to them what I was looking at and my entry price, which you can see there, my exit price, and my stop loss price. And as you can see, if I go over to that actual trade, it has done very, very well. This trade itself that you see on the screen was based on the exact strategy I just told you. So as you can see, this trade was not exactly in hindsight, as I did take it and send it to all the members of the EAP training program. And by the way, they get 3 to 5 of these type of trade alerts each and every week. Of course, not all of them are winners, and especially not winners like this. You will have losses in trading no matter what. But if you are interested in learning some more advanced material than what I share here on YouTube, and if you want to know the exact rules of all the strategies I use personally, along with getting 3 to 5 email alerts each and every week, and this is a mentorship program, meaning that any questions you have about trading, it'll be me personally answering those questions for you. And on top of all of that, the absolute best part of this is that there is a 60-day money-back guarantee. So if you, for any reason, are not satisfied within 60 days of purchasing the EAP training program, just shoot my support staff an email and they will get back to you ASAP and send you a full refund of your purchase price. But that was our second example here of this specific trading strategy. Let's take a look at a bearish version so you have a full grasp on everything. And then we're going to talk about how having a strategy like this is not the only piece of the puzzle you need in order to be a successful swing trader, in order to not blow your account as a swing trader, and more importantly, or just as importantly, in order to be a long-term, consistently profitable, successful swing trader. So let's go ahead and dive into a bearish example now, and then we'll move on to the other important parts of trading. Okay, so for a bearish example, we are in a downtrend, and is this a new swing low? Yes, it is. We can see that we have now pushed down to a new swing low. We now have 1, 2 pullback candles. At that point, this is validated for me with this trading strategy as a pullback. So at the point that we have a pullback, what are we waiting on with a bearish entry? We're waiting on selling pressure or a red candle, and then a retest of that zone between the swing high and the swing high body, and then another red candle. At that red candle, it's where our entry goes, stop above our highest high of the swing high, targets for trend continuation. So let's take a look at what happened and kind of dissect this trading opportunity. There we have a red candle. So at this point, we're looking in this zone to see if we can get a green candle pushing back up and retesting this zone, and then another red candle showing us selling pressure. We get a red candle, we get a green candle, we get another green candle, and another green candle. At this point, have we broken out of my zone? Yes, we have. The body of this candle closing above my zone means that I'm no longer looking for a red candle at this point. Now I have to redo my entire analysis because this is no longer the swing high of the current pullback. This is because we have a higher high and a higher close. So now my box looks like this. And if we get a new higher high, then it's going to have to go higher. So let's just continue looking at price and dissecting this specific trade. Now we have red candle shooting down, and this right here is my zone because this is my swing high candle, the swing high of that candle down to the body. We now have our zone that we want to see the market come up and retest. Let's see what happens. Oh, we get a retest of that zone. Now what are we waiting for? Now I would be waiting on a red candle for selling pressure, because at this point, essentially, I know it's not exactly a double top. I'm just going to call it that for simplicity's sake. I have a double top while in trend to the downside, all below the 50-period moving average. One of the nuanced rules is I cannot keep looking for this once candles close above the 50-period moving average. Once that happens, I'm not considering this market in a strong enough downtrend for me to want to trade that strategy. So that's one of the nuanced rules you need to pay attention to, and you need to test for yourself. All of this needs to be back tested. We are going to talk about that plenty in just a second. Now, what are we waiting on? We're waiting on a red candle. Boom, there's my red candle. How does my trade setup look? Looks like this. I have an entry there, 1 ATR on my entry candle. And if you're not sure what ATR is, it's right up here. In the top left-hand side of my screen, you can see ATR. It's an indicator on every trading platform. Go to your indicators, type in ATR. You will find it. I have it with all the regular settings. So at the point of my entry, the ATR is 94. What that means is I would need a 94 pip stop loss, and I want that stop loss above our previous swing high. So up to our previous swing high is 88, plus 90 would be 178, plus 4 would be 181. So we have 181 pip stop loss, and we are looking at a target at a 1.4, which is what I like to personally use. And let's hit play, see what the market did. Push down and finally hit targets. Let's take a look at one more bearish example, and then we'll move on. Okay, so here we are making new swing lows yet again, right? We have a swing low, we have more than 2 red candles, we have a swing low and a pullback all below the 50-period moving average. Everything's lining up for a possible bearish trade using this strategy. So now we are waiting on a push down, right? Push down with a red candle, and then a retest of that zone, and then another red candle. Those were the worst candles I've ever drawn in my life. But with that being the case, let's click play and see what happens. There's our red candle. Now we have our zone that we're looking for a retest in. And once we get that retest, we want confirmation with another red candle. So let's keep pushing and see what happens here. We get our retest. That's not a red candle yet. We get higher. Here we go. Continuing. Oh, actually, that is our red candle right there. So the reason that is a retest and a red candle for confirmation is because we are still inside of my zone. We didn't close above it. We closed inside of the zone, and we did have a wick that went above it, but that's totally fine. We do have candlesticks touching the 50, but have we closed above the 50-period moving average? No. So everything's valid about this trade, and this red candle would be the entry. Let's go ahead and do that. 214 on stops would put a 1.4 about the same spot. Okay, let's click play and see what happens. Holy shit, it lost. Yeah, guys, it lost, and I did that on purpose. I just wanted to show you one losing trade so you understand that it's not some holy grail. No strategy ever will be. This is just something that has provided me with an edge over the market in the past years of my trading. It's a simple, rules-based way to make really accurate trading decisions while swing trading in any market. And it's very logical. You're trading with the trend. You're using structure and candlestick patterns in order to try to capture the end of a pullback before that next impulsive move up or down while the market is trending. But here's the bad news. You can know this strategy like the back of your hand, and you still could end up blowing your account or not making money as a trader or wasting your time trying to do this or losing a shitload of money. Why? And how is that if this is a strategy that provides an edge over the market and makes money over time? Well, there's a lot more factors that go into trading successfully, whether you're day trading or swing trading, than just the strategy.